Okay, we're back here again to talk about the income side of the equation of commercial properties. I'm going to use a completely hypothetical 100-unit apartment complex. Let's just assume that we have 1-bedroom, 1-bath units. We have 40 of those units, and they rent for $500 per month. Pretty simple. 2-bedroom, 2-bath units. We have another 40 of those, and we make $600 per month on those units. And we have 3-bedroom, 2-bath units. Say we have 20 of those, and those rent for $800 per month. Well, 40 times 500 equals $20,000 per month in income. 40 times 600 equals $24,000 per month. And 20 times 800 equals $16,000 per month. So, if every one of our units were occupied and paid rent every month, that would total $60,000 a month, or we always use an annual figure on this. That gives potential rent Our potential rent then is $720,000 per year. Remember, that's if everybody pays their rent. Now, we do lose money. We can't collect all that money because that assumes every unit all year long pays their rent at our asking prices. That virtually never happens. Let's just say a real life example, maybe our 1-bedrooms, they're just not leasing for some reason. We decide to run a special on those and lower the rents on those from $500 to $400. Well, we are now signing a lease that says that they can pay less than what our rent is. Well, that is called a loss to lease. So we're going to go ahead and put down loss to lease. That puts our loss to lease. I'm going to go ahead and use $14,000. Because we ran specials. That's loss to leases because of the lower rents at certain times of the year. But it also might be a move-in special. We do a $199 move-in special, or we give a free month's rent. That's a loss to the lease. Now, each unit is not going to be occupied all year long. We're going to have turnover. There's going to be vacancy. So, let me correct this. That is minus loss to lease, minus a vacancy, because there's going to be units that are vacant. Let's just assume $70,000 in vacancy loss. Now, you're going to have also people that just don't pay rent. They didn't pay rent, so you've got to evict them, get rid of them. So you're going to have a collection loss, minus collection loss. I'm going to go ahead and assume just a $16,000 collection loss. None of these numbers are overly outstanding and would definitely need to have some attention paid to them. This gives us a total income, rental income, this gives us rental income of $620,000 per year. But that's not all our income sources. We also get income in other ways. We lump these together as other income. Now, our other income can be application fees, laundry income, vending income, late fees, administration fees. You could charge back for utilities, for water, for electric, for gas, for trash. You can have any type of fees you want. You can have pet rent, non-refundable deposits, anything you want to collect more income. We'll lump those all together in other income, and we'll use other income as $10,000 for the year. By the way, that's not a lot. Gives us our total income of $630,000. Now, since we're only talking about income, I'm just going to go ahead and plug in expenses then. Let's plug in expenses at $300,000. Now, income minus expenses equals what? That's right. Net operating income, or NOI. Gives us $330,000 in net operating income. We'll go into expenses in another video. Now, you remember how to value a property? Net operating income divided by a cap rate, and let's use a 10% cap rate. That would mean this property is worth $3,330,000. That equates to $3,330,000 divided by the number of units equals $33,300 per unit, which is a good way to compare one property to another. How much per unit is it? $33,000 per unit versus another one that might be anywhere from $10,000 a unit all the way up to $150,000 a unit. It all depends on the income they produce. There are a lot of ways to go ahead and increase your total income. As you just looked at, you can have less loss to lease. You can increase your occupancy, or you can decrease your vacancy and collection loss. Now, on a yield-based investment, these are going to be pretty firm numbers. You're not going to be able to operate too much better than that. But on what we call a value play, you're not trying to just get a yield, you're trying to rapidly increase the value of the property. So let's just say we looked at this property and said, hey, wait a minute, there's opportunity here. It's not being managed as well as it could be. And let's just say, well, our loss to lease, we can get that down. I think we're a better management company. We can go ahead and get that down. And let's just say that's only $4,000 rather than $14,000. So that adds $10,000 into our bottom line. Let's say our vacancy. Well, they have a high vacancy. They're losing $70,000 because not all the units are ready. Well, we're going to go ahead and put some money in to fix those up and get them ready and get them leased out. Well, let's just say we can cut that quite a bit. And now it's only $40,000 in loss to lease. Well, that just added $30,000 to our income. Oh, and that collection loss? Oh, we're just not screening the tenants properly, and they can't afford it. So we're going to go ahead and do some things to increase our tenant mix, get some better clientele in there, and get rid of that. We're still going to have some, so let's take that to $6,000. So that puts another $10,000 into our pocket. Well, in doing this, we just increased the collections by $50,000. Now remember, that $50,000 will increase our net operating income by that amount because our expenses don't go up just because we are operating the property more efficiently. Well, now that income is $380,000, which gives us a value at a 10 cap of $3,800,000. By becoming more efficient and saving that $50,000 puts $50,000 more to the bottom line, which increased the value of the property by $500,000. You just made $500,000. This is just on the income side. This doesn't include the expense side. And we didn't raise rents. All we did was operate this more efficiently and increase the value of the property by $500,000. That's how you create wealth in real estate. Just one of the many ways. So that's the income side of the equation. You can raise rents. We didn't even look at raising other income. Can we bill them back for water? Can we bill them back for utilities? We can raise those fees also. There's a lot of ways to do it. Every property is different. And you just need to know what you're looking at, how to do it, or team up with somebody who does, that can make that jump for you to increase that income and increase your net worth just by being more efficient.